We can call it a bunch of different things. We can call it a possible stalling out. We can call it exhaustion. We can call it we're going to get tired of this rally. There's not much left to go. What I would focus on right here is that this is a tough time because we can make both a bear case and a bull case. And in this case right now, if we look at a bull case, it's things like momentum driving us forward. It's stimulus that's still here and looks like it's here to stay. It's the assumption that we're going to have a recovery or a reopen that's uninterrupted. So it's interesting to make that case. And right now, I think the recovery is really innocent until proven guilty. So the market can continue on this path until we get information, if and when we get information that disappoints it. I continue to think that the second quarter looks like a throwaway to everybody. Nobody's really concerned with the level of data that we're getting. It's more about the third quarter. And once we get expectations on the third quarter, that's where it really comes home to roost.
All right, so innocent until proven guilty also implies that there's still at least a little bit of caution or skepticism in people's playbook right now. And I want to turn this now to Goldman Sachs and their chief equity strategist, David Kostin, because in a note this morning, he tells his clients that their S&P 500 forecast shows 2% upside to their 2020 year-end target of 3,000, but 18% downside to our three-month target of 2,400. Also adding there that investors are dismissing concerns, bank loan losses, fewer stock buybacks, dividend cuts or pauses, policy uncertainty, all of those things weighing in. So maybe we'll now turn to you, Jim Lebenthal, about this because, you know, Liz just laid out a playbook there, exercising at least a little bit of caution. But it sounds like Goldman says we could see another possible 18% downside. Is that in your realm of reason as well?
Not that magnitude, but Dom, that's a nice setup. And the commentary from Steve and Liz were very good from the point of view of, hey, you know, maybe the market is looking through this. We don't know if it's right or wrong that we'll be back to normalcy in 2021. But I'm going to take a stand here, and I have for a few weeks because I've been raising cash, and I haven't committed any of it, and I'm not going to commit it today. My next move is likely to be to sell more equities. And the reason why is when you look at the economy, some of the things that David Kostin pointed out really ring true to me. I think about, just for instance, the work from home phenomenon, which is likely to continue past this crisis ending. And that's going to put tremendous pressure on commercial real estate rents. It's going to put pressure on commercial real estate prices. It's also in the metropolitan areas. It's going to put pressure on restaurants that normally cater to business lunches and dinners, high-end retail. It's going to put further pressure on unemployment. And when I say pressure, what I mean is not that things are going to get worse. We've almost certainly hit the lows in the last month. But the problem is the market is pricing in a recovery rate that is simply too strong for the fundamentals that I see. Just another example, maybe piling on here, but over the weekend there were a lot of press items about United Airlines flying an airplane at capacity, and they were lambasted for that. Well, you know what? That's not good for profits. It's not good for equity holders if it's socially unacceptable to maximize your profit. And for health reasons, that is the case. So bottom line is this. The market is looking through the canyon of the COVID crisis, but I think it is way too enthusiastic about the rate of recovery. I am cautious. My next moves are quite likely to raise more cash.